Something huge is happening with mortgage rates right now, and we need to talk about where they're going in 2025. So we have seen some of the largest swings in the 30-year fixed rate that we've seen in a very, very long time. And this is essentially being caused by the large drops and rises in the 10-year treasury yield. If you're unaware what that is, it is essentially the yield that investors get from buying a 10-year bond. And this dictates where interest rates and mortgage rates are going to be headed. Now, earlier in the year, we had rates around 7.2-ish%, and about a week ago, 10 days ago, they dropped to as low as 6.3%, which was great having these numbers. And in all honesty, everyone was anticipating that they were going to remain low and continue dropping. We were getting news that potentially the Federal Reserve is going to be cutting rates more than everyone anticipated. And all of this news together was kind of aligning with mortgage rates continuing to decline. As of this morning, at the time I'm recording this video, mortgage rates are back at 7%. And a lot of this is due to foreign investors selling a large amount of government bonds, forcing the 10-year treasury to skyrocket. In fact, at the time of making this video, it went from 3.85 all the way up to 4.5 in a matter of 3 days. That is something I personally have never even seen before. And if you're new here, my name is Iain Phillips. I am a local realtor in Southern California, and I like to talk about the economy, how it's going to affect real estate prices, deep diving into some data to see where we could potentially be in the future, and kind of provide valuable information for home buyers and sellers. If you're looking for an agent in Southern California, reach out. I'd love to chat. Maybe I'd be a good fit for you. Let's get on with the video. If you're unaware how the rate is dictated on a government bond, it's quite simply supply and demand. So the more people who are buying the bond, the lower the rate goes because there is more demand for it, so they don't need to increase the rate at which the government is lending money to investors. And the more people who are selling the bond, the higher it pushes the rate because they need to increase the demand for that bond, and the higher the interest rate, the more enticing it is for investors. And we owe a lot of debt to foreign countries, as the US bond is seen as one of the safest investments in the world. There are a lot of theories as to why foreign investors are dumping government bonds right now. One of them is to do with the tariff trade war that is occurring. Essentially, if enough investors are selling government bonds, it's going to push interest rates sky high, which in their opinion might cause the administration to drop all tariffs, because if interest rates skyrocket, we're going to be unable to refinance a lot of government debt right now, and there could potentially be a crisis unfolding if interest rates get high enough. So how does this affect you and the real estate market? Well, if the 10-year treasury continues increasing and if it goes above 5%, we could see mortgage rates as high as 8%. And I know nobody wants that, but we did get it about a year and a half ago. And in my opinion, we need a lot of economic data to support the Federal Reserve cutting rates and cutting rates fast, because we do not want to get into a situation where mortgage rates are 8.5%, and it's just going to put a complete freeze on the real estate market and make the debt that we have as a country and the debt that banks have with commercial real estate debt and other debt unable to refinance. And we need lower rates to give everyone the opportunity to refinance. Otherwise, credit could freeze with the lack of ability to lend out money and refinance the high interest rate debt that a lot of people are holding. So how could we see lower rates in the second half of 2025? Well, if inflation carries on going down, then it will give a better environment for the Federal Reserve to cut rates multiple times. As of right now, there is only a likelihood of 2 more rate cuts before the end of the year. On top of that, if the unemployment rate carries on going up, in the recent report it came out at 4.2%, then we will see an even higher likelihood that the Federal Reserve will cut rates, because one of their mandates is to maintain the job market. And if the unemployment rate is rising rapidly, then they will be forced to cut rates. Now, we've seen huge turmoil in the stock market. Some days it's up 10%, other days it's down 6%. So that could be another reason the Fed cut rates. If the market continues to decline, continues to have enormous days where investors are losing a lot of money, then the Fed might be forced to cut interest rates. And there is some speculation as to the cause of this market crash. Some people are thinking that they're doing it on purpose to force the hand of Jerome Powell, who is the chairman of the Federal Reserve, and get him to cut rates sooner than everyone is anticipating. But realistically, we need to be looking at number one, inflation, and number two, the unemployment rate. If we can get the unemployment rate to above 4.5% and maybe closer to 5%, then in my opinion, we could actually have mortgage rates back in the fives by 2026. A lot of economists are anticipating that mortgage rates don't really do anything for the remainder of the year. They think they're going to hover between 6.5% and 7%. But realistically, if the data is supporting a rise in unemployment and inflation continuing to decline, then the Fed is going to cut rates more than twice. And that could lead mortgage rates to go back to 5.5%, maybe even 5%. And I know that's kind of a sweet spot for a lot of buyers, because if you are unaware, if mortgage rates go from 7, which they are right now, down to 5, and home prices increase by 20%, your monthly payment remains the exact same, which is mind-boggling to even think about. So home values could go up 20% if mortgage rates drop to 5%. Yes, we could see a huge surge in demand if mortgage rates get to as low as 5%, but it will also balance out with the unemployment rate. If there's a lot less people with jobs, then potentially a lot less people will be buying homes. But it does make a huge difference, particularly for first-time home buyers who usually put a lower down payment down in order to qualify to buy a house. As I just mentioned, just a 2% swing in the 30-year fixed makes a huge difference in where home values could be. If you like this video, subscribe for more. I'll be doing some more updates on what's going on in the economy and how it is affecting the real estate market. My name is Iain Phillips. I'm a local realtor here in Orange County. So if you need an agent in the area, reach out. I'd love to chat and maybe I'd be a good fit for you.